Welcome to the distributions. Are they taxable or are they not taxable? It's a topic that is, I always hear a lot of people saying, well, just discuss their distributions and talk about the taxation of the distribution. Bottom line is, except under very rare circumstances, distributions are not taxable. So I'm going to show you that kind of problem or how that all works, so you just have a good understanding, or at least a better understanding, of why distributions are not taxable. So my name is Brad Rourke, and I'm with the Williams Group. I'm a CPA, and also have my ABV, which is the Accredited Business Valuator. Yeah, I've been blessed to be with the Williams Group for 20 years now, and time flies. So that's just a little bit about me. I really like tax. I like tax policy. I'm interested in tax policy. Yeah, I love working in your profession, because you've got a lot of different tax issues with the optical, with the retail activities, and then you also have the professional activities. And lots of you own your buildings, so you've got rental issues, depreciation issues over there, and then you've got your clinics, and so you've got so those are just your business issues. But then a lot of you have farms or into cryptocurrencies or Airbnb and whatever the case may be. So working within your profession is a blessing, quite frankly. And it's just great to have a homogeneous group of clients, because we only work with ODs. So we have 3 divisions in our company. Just really brief on this. So our consulting division, which is run by Robin Elliott, and then our transitions division, which is helping buy and sell and bring on partners. We're very good at that because there's a lot of tax issues also bringing on a partner. So that's run by, who many of you know, Mr. Bill Nolan, good friend of mine. Appreciate his friendship. And then our tax and accounting group, which I oversee along with Archie Keebler, who's also a CPA, and Patrick McReynolds, who runs the accounting area. So that's kind of our overview of our company. So we've got a pretty good financial and consulting and transition groups, and a lot of expertise to help our clients. So that's a little bit about us. So let me see if I can move this slide deck forward. Great, done. So just brief agenda, why are distributions not taxable? So we're going to go through that, and I'm going to show you from a detailed level. And I think it's going to be helpful, because you can look, if you want to grab your tax returns right now, if you've got an S corporation, if you can pull it up, great, no big deal if you can't, because I'm going to show you an example of one. And then the second thing we'll talk about briefly is tax efficient methods to get money out of your S corporations or out of your clinic. So I'm primarily going to stay on S corporations. Predominantly, I would say 70 or 80% of ODs, they're practicing from within a LLC, which is elected to be taxed as an S corporation. So we're going to stay mostly on that. There are other different operating vehicles, of course. You can have an LLC taxed as a proprietorship, or you can have a partnership. But those C corps they're very rare. So, but like I said, most of the taxing entities, so to speak, are S corporations. So we're gonna primarily focus on those. So let me just toggle back over to my numbers here. I'll get this thing out of the way. You can't see it, but it's in my way. It's blocking some of my screen. Yeah, maybe I'll just move it way over here. Okay. So I'm going to give you a little bit of context first, so that I don't know how many people actually look at their tax returns these days, because they're very complex. It'd be 90 pages or 70 pages, including the state tax returns. So there's a couple of schedules that out of that massive stack of tax returns that you might get electronically from your tax preparer. So I'm going to just show you two schedules that are worth looking at. So this is an S Corp return, 1120S, 2023 form. So a couple of numbers just to pay attention to, because we're going to talk about these yellow highlighted lines. So 1A is pretty simple. That's your gross receipts. So that's essentially your production or cash that you paid. Most taxpayers or S corporations, which I would recommend, are electing cash-based tax on their S corporation. So then the next one I want to show you is line 7, compensation of officers. So that's typically going to be you, the owner. So your wages are going to hit this box here on number 7. So that ends up being a deduction. So you're not paying, you pay tax on that personally. That hits your 1040. So that's a deduction from your S corporation income. So that's line 7. And then line 14 is an important line also. That's your depreciation, because you've got some flexibility on your depreciation. You either take section 179, which most doctors aren't doing these days, or S corp owners aren't doing, because we've had bonus depreciation through the Tax Cuts and Jobs Act, but still hits line 14. Or you could be doing makers, which is over 5 years, 3 years, 7 years, depending on what the assets are. So this is a variable that you can use, or we can use, for tax planning. And finally, just on page 1 of your S corp return, the other number to look at is your ordinary business income. So this ordinary business income, you're taxed on 2 numbers here. You're taxed on this number, your wages, because that hits your 1040. And then 1040 is your personal tax return. And then you're also taxed on line 22, your ordinary business income. You can't tell that from your just looking at your S corporation tax return, but that's your ordinary business income. So I'll just jump over here, because I think I've got the K1 up here. So this goes on line 1 of your K1. So then when you get your K1, that's going to go on to your personal tax return, and you are taxed on this K1. So that is this number right here, line 22. So those are the 2 numbers you're taxed on: your wages and then your ordinary business income. Then this goes to the whole idea of your distribution. So this is Schedule M2. It's on page 5 of your, so this is effectively page 1, and then you go down to page 5, and then you're going to see this little schedule here. It's called your M2. So it is your undistributed taxable income previously taxed. So that's a really important. So in the accounting business or tax business, we call it AAA account, because it's the accumulated adjustments account. But effectively, for your purposes, this is the amount of distributions that you have that you can distribute out to yourself, and you won't pay tax on this on the distribution. So as long as this balance is positive, the opening balance, and as long as this ending balance is positive, so line 8 and line 1. So line 1 is the beginning. So if you've got any number here on your tax return, that means you can distribute that money out to yourself and pay no tax on it. So the way this works is line 22, which goes onto your K1. It also flows over here to this M2 balance. So because this goes onto your K1 and onto your tax return, that means you are taxed on this number. So it goes here saying, so once it goes here, then you've already been taxed on this. So as soon as or whether you paid your taxes, that's a different matter, but you owe taxes on this amount. So once you pay tax on this, it goes on to this M2 schedule, and that's your ordinary income. This number does not. The way your compensation for your officers, that just goes on to obviously a different line item on your personal tax return. So you're taxed on this regardless of whether or not you take this money out or not. So that's a primary key point. So this thing rolls forward every year. So you've got your beginning balance, and you can just consider this as money that you have in your clinic that you have already paid tax on. So that's so at the end of last year, you'll see, well, it'll roll forward to 2024. Oh, actually, well, we're in 2023 tax year, but so this will be your ending balance from 2022. Then this income hits this line too. So it means you've already been taxed on that. So let's just say this is $100,000 opening balance, and you got $200,000 of taxable income here, which you've been taxed on. That increases your amount of distributions that you can take out and not pay any tax on it. So because you've already paid taxes on it up here. So it gets added. And then when you take the distributions, these distributions, and that's the main point, just to understand that distributions are typically not taxable. They can be taxable only if this number at the end of the year goes negative. If it goes negative, that's a bit of a problem, but typically most tax preparers, if it does go negative, they will reduce these distributions as a bookkeeping entry and put it on your balance sheet as a loan to you. So if you see a loan to shareholders, and sometimes I'll just show you where it is typically on your tax return. It'll be on your books too, but if you see a loan to shareholder, that means you probably distributed more money out to yourself than you've actually been taxed on. So loan to shareholder. So this can be problematic if you have a positive balance here and you don't have a formal loan agreement. So that's you should look at that number on your tax return and see if there is one on line 7. It's fine if you've loaned money to your company, and that's line 19, loans from shareholders. This is loan to shareholders on line 7. So let's just go back to this here, and we'll continue talking about this for a moment, the Schedule M2. So if I was you, those are I would typically just go look at this schedule if you have an S corporation and see what your balances are. So again, when you distribute money out, 100,000, say ends up, you got 200 grand here, say opening balance is 0, and then you've got $200,000 of taxes here or taxable income. That goes here, so you're taxed on it. That means you can take out 200 grand. You can take out 150, but if you take out 250, this goes negative. Then like I was saying, it can be a little bit problematic because technically, if it goes negative, it can be construed as a dividend to you, which you'd pay 15% tax or 20, depending on your case. But typically, you could always ask your accountant if you have a negative balance here. Just ask them about it because it gets a little complex. But that's the deal. As long as you have a positive balance here, then you're not paying any tax on your distributions because, like I said, you're only paying tax on this number because that hits K1 and you're paying tax on that. So I think that's might be reasonably clear now. So I just want to show you another really important decision factor, which can save you a lot of tax. I'm going to make sure I'm watching the time here. So here's a couple scenarios, which at the end of the day, I'll show you how you can save $15,000 of tax, or 15% really, which is FICA. So let me just go through the scenario. So you got a clinic, good solid clinic doing 1.2 million. I'll just assume it's a single owner clinic. So 1.2, and then you push out $200,000 to yourself in wages. So that's a deduction because you get paid on that. So it's actually deducted from your company, from your S corp. And then you said, let's say you got this depreciation of 50,000. And then you've got all your other deductions, all your overheads, your staff wages, everything else. That's 750. So then at the end of the day, you've got business income of 200,000. So just repeating myself, that 200,000 goes here, ends up going down here to increase the amount you can take out tax-free. So you've got taxable income of 400,000. So on this $400,000, these two numbers are taxed quite differently. and when I say quite differently, I mean 15% differently. So $200,000, you're going to pay. So this is your wages. So on the wages, you're going to pay if you're taking 200 grand, you're going to pay 78,000. So the reason why, let me just scroll back over here so you can see. So your tax rate effectively on these wages is, you can see up here, it's really small, but it's 24% plus the 15. So you're paying FICA. You're paying extra 15%, 15.3% on this money here. And then this $200,000, if you're at the 24% tax rate or whatever rate you end up being, your highest rate, then that gets applied to your business income. So just on this, essentially, you've got $400,000 of income, which is the total of your $200,000 you took in wages, and then the $200,000 not on your distributions, but on whatever's hitting this line right here. That's what you're paying tax on. So 200 grand in this case, wages, $200,000 of business income, total taxable income, 400,000. So on this $200,000, you pay an extra 15% because wages attract FICA. And then on this $200,000, then you don't pay FICA, you're paying 48 grand. So there's a big difference in tax between these two types of income. So in total, you're paying 126. So if we switch this up a little bit, and you could, obviously you could, so in this case, I've said, okay, instead of the $400,000 being split evenly between wages and business income, I'm going to just take 100 grand of wages. So everything else is the same, except now my business income is, which goes on box 1 of the K1 and flows down. I won't scroll down because I think you've got that idea that this ends up going on your K1. So still $400,000 of income, but you switch it up. You lowered your wages, you lowered your compensation down to 100, and then let the rest of it flow down to box 1. So in this case, you're paying $39,000 on your W-2, and then you're paying $72,000 on your business income. So when you add them both up, you save $15,000. So effectively, for every, say, $10,000 that you switch, so you reduce this, I'll just put this, I'll do it over here because I've got this. So if I switch this down to $50,000, which is a little low. If you're making 400 grand, I wouldn't recommend you take 50 because you have to take a reasonable salary. So now you're down 50,000, and then your business income automatically goes to 350 because it's still, you're just taking it out differently. It's $400,000. So maybe I'll just make these the, yeah, so let me just switch that back because I'm going to get confused with these two different numbers here. So I'll just do it in this column so you can see that this 15,300 is going to increase. So let's just put this down to $50,000 instead of the 100 and put that to 350. That's right. So now I've taken 50,000 of wages and I've got the rest of it flowing down into my income onto my K1. So just on that, by switching that, I've saved another, whatever that was, another $5,000 essentially, from $15,000 now up to just over 20 grand. So you can see, so effectively every $10,000 that you reduce your wages by, you're going to save $1,500. And there's other impacts too, based on the qualified business income deduction. So in general, the point is, ideally you want to keep your wages as low as possible. I guess sometimes there's complications with that. If you've got partners, you have an S corporation, then the only way to get money out to one of the partners, if their production is more, is to pay it by wages. So there's some complications here, but the point is, you want to weight your compensation not towards wages, but towards your business income. So it doesn't matter what you do with these your distributions down here. As long as your ending distributions is positive, you can just take out your cash. So I do see a lot of clinics or a lot of owners that are sitting with a fairly comfortable bank account, like $200,000, $300,000, and then they do have a positive number here on this M2, where they can take that money out, because normally you're not investing inside your clinic, so you want to put it, you distribute the money out, put it into crypto or something like that, and then that's a little risky, but it's not it's not doing you a whole lot of good sitting with excess cash in your clinic. So you can always just loan the money back into the clinic, and then so that's all fine. There's no tax consequences doing that. So just take the cash out, and then if you want to buy a piece of equipment or whatever you need to do, you can liquidate some assets that you have personally. So I would tend to keep my cash balance in my clinic reasonably low, but it's nice to see a bank account, but it's not really doing you a whole lot of good if there's opportunities for you to invest that. But certainly investing it back into your clinic is the way to go, because most clinics are generating like 30 to 40% on their production. So yeah, that's all I'll say there. So that's it on these distributions. So they are not taxable. They're only potentially taxable if you have a negative balance here, i.e. you've distributed too much out, which means you've distributed out more than you've earned historically, because this is a running balance. Some of you might also see a balance here, and you can add these two up, because recently with the PPP loans, they were not taxable. So that's essentially income in a sense that your clinics received that you were not taxed on. So that really increases the amount you can distribute out to yourself tax-free. So if you have a balance here in column D, it's probably your PPP income. So you can, so you add these two numbers together, that's the amount of money you can take out, distribute out to yourself without paying any tax on it. So what else did I have here? It's probably, I think I covered everything here that I wanted to. So I'm just going to move on real quick here to some other ways that you can extract. I'm sure why I use the word extracting, but it sounds a little exacting. But extracting money out of your clinic in a tax efficient way. First one is just saying what I just said. If you've got cash and you've got a balance on your M2 undistributed previously taxed income, and you've got excess cash, that's distributed out to yourself. So that's number one. Income splitting is really good too, and that just goes back to these tax rates here. If you've got children and they're down in the 0% range, you can pay them $12,500 each, and they're not going to pay any tax on it. Whereas if you're up in this 32 to 35% rate, your overall family is saving a significant amount of tax just by paying children or paying your parents. So that's certainly a great way to lower your overall tax rates. Another thing we typically will advise is or establishing a home office. So you can establish a home office and have it be an administrative home office, as long as you're using it exclusively for business. So you're looking at charts. Maybe you might be finishing up some charts. You're looking at your accounting. You're doing administrative things. You might be paying bills. You do that from home in an office. So once you've established a home office, then you can deduct that percentage, and we do it by rooms. So you got 5 rooms in your house. 1 room is your home office. Then 1 out of 5, that's 20%. 20% of your home cost you can deduct, including the depreciation. And then once you have a home office established, then you can also deduct your commute. Because normally you're an S corporation, you're an employee of your S corporation, you can't deduct the commute going back and forth, the travel back and forth, your mileage, any of that. But once you've established a home office, then you're not going from your home residence to your place of business. You're going from your home office, or your office, or another locale office to your clinic office. So then you can deduct that travel back and forth. So that's another great deduction where you just reimburse yourself. So you're expensing those deductions inside your company, and then having that paid to you. So you get the expense on the company side, and then when you receive that cash, you're not paying tax on it. So it just lowers your tax rate. And these are pretty standard too, just retirement plans. So essentially 3 401ks. They're the most complex and burdensome from a administrative point of view. But you get the highest deductions up to, I'm not sure the numbers are this year, at least 23.5 for 401k, and then simple IRAs. I like simple IRAs, and you can deduct at least 13,500. Simple IRAs for a good reason, and that they don't have, their administrative fees aren't as high, nor are the administrative reporting burdens on simple IRAs. So they're great, and also of course IRAs. So if you don't want those two, IRAs are always good. Health savings account are good also. You can deduct 3,500 into HSAs. So you can deduct it, put it into an HSA account. As long as you're using that for healthcare purposes, then you get the deduction. So there's also, like I mentioned, loaning yourself money. So if you don't have any, if you have this, there's some, I won't get into it, but there's some reasons why you might have a fair bit of cash. And really, I will mention the reason why. You might have a fair bit of cash in your bank account, but you don't have any. This is getting really close to zero, if not, potentially even around negative. So that's typically occurs because of depreciation. Because let's just say you had $150,000 of equipment in a particular year, then you deduct all of that. You can deduct the whole thing, bonus depreciation. So when you do that, you're not paying all that. So you finance it. You're only paying, say, 1/10 of it. Depends how long you finance it for. But you're taking the entire deduction. So it drives down your taxable income or your business income. Just remember, this gets really low. It might even be zero because you've got all these equipment deductions or leasehold deductions. Great, that reduces this number here. But then you've got cash, but you've got no room to distribute your money because you've got nothing in this, no room here. So you could loan yourself cash if you need cash. So out of your business in those situations. So it's always better to have a real loan agreement because the IRS is pretty rare. I personally have never seen it, but they could say, hey, that's not really a loan, that's really a distribution, and you've distributed more income than you've been taxed on. So really, that's a dividend, and you can get taxed on that. But quite frankly, I personally have never seen that done with the IRS, but still, just something to be aware of. So yeah, so that's exactly a half hour. So if there's, I think that's kind of it for the content. My contact information is here also, so feel free to reach out to me. You can call or text or excuse me, email me. Thank you, everyone. Happy distributions and Friday. So God bless you. God bless everyone, and hopefully we'll connect sometime soon. All right. Bye-bye.